Hi, I'm Martin Pring. They say that a picture is worth 1,000 words, but I say that a chart is worth 1,000 pictures. And that's because charts in the financial markets often scream out very important messages that an important or significant trend reversal has taken place or is about to take place. Each month I publish a newsletter called the Intermarket Review, and each issue contains what I call the chart of the month. And that features a market that I think has just turned or is about to turn. So this series of videos aims at presenting these charts of the month. So if you're interested in them, please hit the subscribe button and you'll be brought up to speed on a regular basis. So without more ado, let's go to the chart room and see what's in store for this month.
The old Wall Street adage, sell in May and go away, does not work consistently, but this year an alignment of economic, technical, cyclic and psychological indicators suggests that the market is particularly vulnerable to a nasty intermediate decline. For my full report on this matter, please go to Pring.com, where you can download a PDF file that sets out my views in a more comprehensive way. 2010 is of course the opening year of the decade. It's also the second year of the presidential cycle, and since 1900 such years have had a bearish bias for at least the first half. This didn't happen by chance, but such periods had either been associated with recessions or a slowdown in the growth rate of the economy. This chart shows the average trajectory since 1910 of the 5 examples where the opening year of the decade and the second presidential cycle year coincided. This brown line shows the S&P action between January and April of this year. There's absolutely no guarantee that the rest of the year will continue to repeat in an exact fashion as has been the case so far. But I have to say that the position of many technical, sentiment and fundamental indicators is consistent with a decline, one of which is the growth path of the economy. This chart features my master economic indicator, or the MEI. The red highlights on the S&P plot represent recessions. The chart shows that equity prices have a strong tendency to rally when leading economic indicator momentum is advancing. You can see that from the green arrows. It often runs into trouble when the growth rate peaks out. In that respect, when the thick blue line, a 6-month moving average of the MEI, flags a slowing in the growth rate by reversing to the downside, the odds are approximately 2 to 1 that this will be associated with a stock market correction of some kind. However, in the 5 instances flagged by these red arrows, when exceptionally high economic volatility results in a reversal from an elevated level above the red horizontal line, equity prices have consistently tanked. Currently, the moving average is still rising, but it's extremely vulnerable to a reversal because the raw number, shown in black, has apparently peaked. As we move forward, last year's favorable numbers for comparative purposes will be removed from the calculation, and new ones, while still reflecting growth, will most likely do so at a slower pace. It's important to note that any topping out action does not forecast a recession, just that the rate of economic growth will be slowing, and this will likely be bearish for equities. How bad? Well, the average mid-year decline for the 11 opening years of the decade since 1900 have been 14% below the January opening. Now 14% below the 2010 January opening for the Dow of 10,400 takes it down to around 9,000. Remember, that's the average. It's not a prediction. The actual number could be better or worse.
If you enjoyed this chart of the month, you may want to go to Pring.com and download a free sample of our Intermarket Review, a monthly roundup of the world's principal financial markets with a special emphasis on the US. We also look at global indicators, bonds, precious metals, currencies and international markets using ETFs to execute our strategies as much as possible. You'll find unique indicators and intermarket relationships you cannot find anywhere else. In the meantime, thanks for watching and good luck and good charting.